Greetings. In today's video we will discuss the book The Intelligent Investor by Benjamin Graham. Stay with me till the end of video for bonus fun facts. First, let's take a look at brief summary of The Intelligent Investor by Benjamin Graham. The Intelligent Investor is a classic book on value investing written by Benjamin Graham, known as the father of value investing. Graham advocates for the concept of value investing, which involves purchasing stocks that are undervalued by the market and holding them for the long term. He stresses the importance of analyzing a company's financial statements, particularly its earnings and assets, before making an investment. Graham also recommends that investors diversify their portfolios and avoid speculative investments. He cautions against following market trends or trying to time the market, instead advocating for a patient, disciplined approach to investing. The book also discusses the concept of Mr. Market, which represents the collective behavior of the stock market. Graham encourages investors to use Mr. Market's fluctuations to their advantage by buying stocks when they are undervalued and selling them when they are overvalued. Finally, Graham emphasizes the importance of maintaining a margin of safety in investments, meaning that investors should only purchase stocks when they are trading at a significant discount to their intrinsic value. Overall, The Intelligent Investor is a comprehensive guide to value investing that provides timeless insights into the principles of successful investing. Now let's go to the summary of each chapter of The Intelligent Investor by Benjamin Graham. Chapter 1: Investment versus Speculation. Graham defines investment as an operation which, upon thorough analysis, promises safety of principal and a satisfactory return. Speculation, on the other hand, involves buying stocks based on hunches or guesses about market trends, without any regard for the underlying value of the company. Chapter 2: The Investor and Inflation. Graham warns investors about the risks of inflation, which can erode the value of their investments over time. He suggests that investors should focus on stocks with a history of paying dividends that have increased over time, as these companies are likely to perform well in the face of inflation. Chapter 3: A Century of Stock Market History, the Level of Stock Prices in Early 1972. Graham looks at the historical performance of the stock market, pointing out that while there have been ups and downs, the overall trend has been upwards. He cautions, however, that investors should not assume that this trend will continue indefinitely. Chapter 4: General Portfolio Policy, the Defensive Investor. Graham introduces the concept of the defensive investor, who is risk-averse and seeks to preserve their capital while earning a satisfactory return. He suggests that defensive investors should focus on a diversified portfolio of high-quality stocks and bonds. Chapter 5: The Defensive Investor and Common Stocks. Graham expands on his recommendations for the defensive investor, suggesting that they focus on large, well-established companies with a long track record of stable earnings and dividends. He also recommends that investors use dollar-cost averaging to gradually build up their position in these stocks over time. Chapter 6: Portfolio Policy for the Enterprising Investor, Negative Approach. Graham introduces the concept of the enterprising investor, who is willing to take on more risk in pursuit of higher returns. He suggests that enterprising investors should focus on buying stocks that are undervalued by the market, using a variety of analytical techniques to identify these opportunities. Chapter 7: Portfolio Policy for the Enterprising Investor, the Positive Side. Graham expands on his recommendations for enterprising investors, suggesting that they should focus on companies with strong financials, sound management, and a history of steady growth. He also advises against investing in companies that are highly cyclical or that have excessive debt. Chapter 8: The Investor and Market Fluctuations. Graham reminds investors that stock prices can be highly volatile in the short term, but that over the long term, the underlying value of the company will generally determine the price of the stock. He suggests that investors should not try to time the market or make frequent trades based on short-term fluctuations. Chapter 9: Investing in Investment Funds. Graham examines the benefits and drawbacks of investing in mutual funds and other investment vehicles. He suggests that while these funds can offer diversification and professional management, they often come with high fees that can erode returns. Chapter 10: The Investor and His Advisors. Graham cautions investors against blindly following the advice of financial advisors and brokers, who may have conflicting interests. He suggests that investors should educate themselves and take a careful, independent approach to their investments. Chapter 11, Security Analysis, The Approach. Graham lays out his approach to security analysis, which involves a detailed examination of a company's financial statements and other relevant data. He stresses the importance of a conservative approach and of avoiding overly optimistic projections. Chapter 12, Things to Consider about Per-Share Earnings. Graham examines the various factors that can affect a company's per-share earnings, including one-time events, changes in capital structure, and changes in accounting methods. He suggests that investors should look beyond a company's reported earnings and focus on its underlying financial strength and long-term growth potential. Chapter 13, A Comparison of 4 Listed Companies. Graham applies his security analysis approach to 4 hypothetical companies, examining their financial statements and identifying strengths and weaknesses. He emphasizes the importance of a thorough and objective analysis in making investment decisions. Chapter 14, Stock Selection for the Defensive Investor. Graham provides specific criteria for the defensive investor in selecting stocks, including a history of stable earnings and dividends, a strong balance sheet, and a low price-to-earnings ratio. He also suggests that investors use a margin of safety in their calculations to account for potential errors or uncertainties. Chapter 15, Stock Selection for the Enterprising Investor. Graham provides specific criteria for the enterprising investor in selecting stocks, including a low price relative to earnings, a low price relative to book value, and a history of consistent earnings growth. He cautions, however, that these criteria should not be used blindly, and that investors should still perform a thorough analysis of the company's financials and other factors. Chapter 16, Convertible Issues and Warrants. Graham examines the potential benefits and risks of investing in convertible securities, which can be converted into common stock at a later date. He also discusses the potential benefits of investing in warrants, which give the holder the right to purchase stock at a predetermined price. Chapter 17, 4 Extremely Instructive Case Histories. Graham provides detailed case studies of 4 companies that experience significant fluctuations in their stock prices over time. He emphasizes the importance of a long-term perspective and of not getting caught up in short-term market fluctuations. Chapter 18, A Comparison of 8 Pairs of Companies. Graham compares 8 pairs of companies in various industries, examining their financial statements and identifying differences in their financial strength and growth potential. He emphasizes the importance of a thorough analysis and of considering both quantitative and qualitative factors. Chapter 19, Shareholders and Management, Dividend Policy. Graham examines the relationship between shareholders and company management, and discusses the role of dividends in this relationship. He suggests that companies should have a consistent and reasonable dividend policy, and that shareholders should be aware of the risks of investing in companies that pay little or no dividends. Chapter 20, Margin of Safety is the central concept of investment. Graham summarizes his approach to investing, emphasizing the importance of a margin of safety in all investment decisions. He suggests that investors should focus on buying stocks that are undervalued by the market, and should always consider the potential risks and uncertainties before making an investment. Overall, The Intelligent Investor provides a comprehensive guide to value investing, emphasizing the importance of a thorough analysis and a conservative approach to investing. Graham's ideas have influenced generations of investors, and his principles continue to be widely studied and applied today. Bonus: there are a few interesting facts about The Intelligent Investor. The book has been in print for over 70 years. The first edition of The Intelligent Investor was published in 1949, and it has remained in print ever since. It is considered a classic in the field of investing and has sold millions of copies worldwide. Warren Buffett is a big fan of the book. Warren Buffett, one of the most successful investors of all time, has cited The Intelligent Investor as one of the most influential books in his life. He has even called it the best book on investing ever written. Graham's investment philosophy evolved over time. While The Intelligent Investor is often associated with Graham's value investing philosophy, he actually refined his approach over the course of his career. In his later years, he placed more emphasis on growth investing and the importance of a company's management team. The book has been updated several times. Although the core principles of The Intelligent Investor remain relevant today, the book has been updated several times to reflect changes in the investment landscape. The most recent edition, published in 2003, includes commentary by financial journalist Jason Zweig. Thank you for watching this video. Hope you find it useful to develop Better You Better Me. If you like this video, please like and subscribe, and don't forget to check my other videos.